Oh, hey, hey, hey. It's Tuesday, and yeah, I was just working on my BlackBerry. Yeah, it's meant to be a joke. This is a piece of 19, what? Oh, not 19, I guess early 2000s technology. And I purposely, obviously, brought this out because yeah, some of what is going on in the markets today kind of like reminds me of the late 1990s and early 2000s. And so I thought I'd break out my old school BlackBerry that I actually bought actually just for like antique value because, I have all these old technology antiques back there and I'm a kind of collector of these things. But before I get into all of that and into the subject of this week's YouTube, which I had to make sure I had notes, which is I want to talk about like what's going on in the stock markets, with big tech stocks, with the market overall, because my sense is there is a tidal shift that is happening, and it's unusual and it's different than before, and I'll get into why. Talk about what in my opinion is a AI bubble in like I don't know, it's like three, maybe five chip stocks. There is a bank panic that is seemingly brewing. Number two, remember we had bank panic number one uh, last year, and then a bit of a Bitcoin update, especially as it relates to the ETF, which is now approved, and what is going on over there. But before I do any of that, very rapidly, want to put up my disclosure, which is that this live stream and the content from ATG Digital Media, which is my company, is not investment or financial advice. It is presented to you as opinion, information, engagement, and hopefully entertainment. Some of you I know laugh and have a good time while I'm presenting. All ATG digital content may contain errors, oversights, and mistakes. Understand that investment operations have significant risk and can lead to the loss of your principal. In other words, you can lose money. Um, the owners, employees, contractors own, trade, transact, and securities that are mentioned in this video, and all content from ATG Digital. Very, very rapidly, here is my free content. We've got the Substack, Ballman Speculating. I actually did a podcast like last week, so check that out. Obviously, YouTube, which I'm currently on. If you want to follow me on social media, I'm quite active on X. I actually do live streams on X. Not that active on Instagram, but Dean puts things up from time to time. Facebook, I do live streams on Facebook, and Dean puts up actually quite a lot of stuff, including excerpts from my Ballman Speculating podcasts. Quick plug, if you want to paid subscriptions, atgdigital.media. All right, let's go to what is going on. So um, I have to say, I've been in markets, like managing money as a professional, from, yeah, like I'd say like from the mid 1990s on. Like my very first jobs were not skilled in the sense like, I didn't really have control of money, but fairly early on, I started to manage smaller amounts of money. And I was an analyst and portfolio manager. And this is one of the craziest, wackiest markets I have ever been in. And I wasn't in the 1987 crash, but I do remember the 1991 recession, which this has some kind of like feeling and sense for. I was around for the 1999 2000 bubble. I was around managing a lot of money by then, by the 2000 and 2008 global financial crisis, like billions and billions of dollars, levered up. Not a fun time. Many people don't talk about this, but 2016 was like a mini crash that no one talks about. But, hey, certainly in growth stocks and things like that, yeah, it was quite meaningful. And then we've gone through the recent smash in 2022. So, yeah, I've got a lot of scar tissue from going through good markets, bad markets, in between markets. And let's just like break down what has been going on, and very quickly just kind of like what set this up. Well, what sets up everything today is really what happened in 2020 with COVID. The Federal Reserve takes interest rates to zero. The US government starts to flood the economy with money over the next couple of years. We then start to see inflation, which, hey, I'll put up, I got wrong. I thought it was a supply chain issue. Turns out it was a money pumping issue. And so then the Federal Reserve, after saying it was not going to do anything on interest rates, lifts interest rates from 0 to 5% in record time. I mean, we start in March of 2021, and we have ended it in, so far it's ended as of July of 2022. And since then, the Federal Reserve has stood still. And in between, what happened in markets? Well, yeah, growth stocks, they started crashing. They peaked in March of 2021. And if you use Kathy Wood's ARK Innovation ETF as an example, they sort of like bottomed out in December last year. The S&P 500 continued to go up as the Federal Reserve raised interest rates, and then went through a 25% smash in 2022. And after that has just rocketed right back up and is now at all-time highs. Other asset classes to think about: government, U.S. Treasury bonds. The ones that go out for 10 years and 30 years, those got smashed. But the others, corporate bonds, municipal bonds, mortgage bonds, yeah, it's as if kind of like the interest rate stuff didn't happen. And so let me start there, which is that through all of my experience, one saying has always been true and has never been untrue, which is that interest rates are to the financial system as gravity is to physics. When interest rates go up, it creates the environment and setup for asset prices to go down. And there has never been a time in which that has not been true until kind of now. Because we have seen interest rates go from 0 to 5%, and the S&P 500 is at all-time highs. Yeah, that's wild. That's crazy wild. The same thing can be said for the NASDAQ 100. Same thing can be said for, here's my list. Big tech stocks, I'm talking about Microsoft and Apple and Amazon and now Meta and others. The same is true for defensive stocks like Procter & Gamble, which is trading at 35 times earnings despite only having growth of 3 or 4%. Berkshire Hathaway, all-time high. So defensive, safety, stability stocks, dividend stocks, the dividend aristocrats, and all of these, also all at all-time highs that are out there. Probably gonna, get some trolls and people who are offended, but Nvidia, SMCI going up by 10, 15% a day, day after day after day. At the same time, we've also got the United States government that has $34 trillion worth of debt. Our interest on our debt is $750 something billion. We've got the beginnings of something that seems to be like a mini bank crisis because of commercial real estate, which is that commercial real estate, it is estimated that the vast majority of old commercial real estate that was put up, let's say 30 years ago, has vacancy rates, depending on the city, of anywhere between 10 to as much as 40 or 50%, but is sitting on the books of banks at 100 cents on the dollar. They are not required to write it off. And so these things, only when they get sold, they get marked to market. And then you see these sudden jumps. Commercial real estate has $500 billion of debt coming due this year and $1 trillion worth of debt coming due next year. And the banks still have not really dealt with either the fact that in the flood of cash that the government pushed out to people in late 2020, 2021, and in 2022, well, that all went into the banks. And at that time, US Treasury bonds were trading at, essentially yields that were nothing. Well, and where did they put all their money into? They put them into 10-year bonds and 30-year bonds. And so they are sitting on losses of 30 and 40%, which is not reflected in the prices of banking stocks. Because if you put 30 or 40, percent of your reserves into long-term bonds and it crashes in price, it means that essentially you don't have money to give back if everybody wants your money. So we've got all of these things like going on, and we've got, if prices were low, then in the way that, I grew up on Wall Street, you would say, stocks climb a wall of worry. But at all-time highs, there's no wall of worry to climb. I mean, it's already climbed. Nothing bad is particularly priced in to all those segments of stocks. Yet people are incredibly optimistic. When I go on X, previously Twitter, there are a lot of people who have very high expectations of what the S&P 500 is going to do, what the defensive stocks are going to do, because there's going to be a recession and somehow these will get bid up again. Yeah, that does not compute. I mean, they've been bid up now for 2.5 years in anticipation of a recession that has not come. To the extent that any recession comes, I mean, these are already bid up. And I mean, at 30 or 40 times earnings, nobody's going to come and buy these as defensives. So that's crazy. And then, AI stocks like NVIDIA. I mean, I saw a chart that said that 5 years ago, NVIDIA was a $90 billion stock. Today, it is a $1.4 trillion stock. And yes, for sure, their sales have gone up, but the price to sales multiple and the price to earnings multiple has gone up far more. This has been a sentiment pump as much as a revenue or growth pump. So you put it all together, and we are in a very weird and very wacky time where something's going to give. My experience on Wall Street is that things never stay the same for very long. And the more people are that are betting on things staying the same, usually that should be your trigger to exit left from everything that has been working, in other words, being bid up, and look to find like, hey, what is not working or what has not worked for some period of time. And guess what? What has not worked? What has not worked is growth stocks. What has not worked is essentially, the sectors I focus on. I call them OGI stocks: opportunity, growth, innovation. What's opportunity? Well, I mean, Fannie Mae, Freddie Mac, special situations of various kinds, particular industries. They have this theme. Like, for example, consumer brands associated with the millennial generation. That's opportunity. Growth, these are companies that are very fast growing. They could be in biotechnology. They could be in any industry. And innovation, in other words, companies that have something new that is very different. The value proposition that they offer is so different than what the incumbent or legacy businesses are. And as a result, they can grow faster. They can take market share. Well, these groups are cheap. Yesterday in my Substack, I talked about this exact issue, and I talked about Block. Block used to be called Square. The ticker symbol is SQ. And Block, has forecasts of 20 or 30% growth, driven by the fact that they've got Cash App, they've got a processing business, they cater to small and medium-sized businesses. And all of these things, give them like a huge runway to essentially take market share from a weakened banking sector. I mentioned all the problems that banking has. They're sitting on an asset base of commercial real estate. I think 40% of regional banks' asset base is commercial real estate. In other words, that's who they lent their money to. Then, they invested in long-term bonds, which are getting smashed. They don't really have the money to lend. So this is a perfect opportunity for fintechs like Square to come in, or Block, which as it's now called, and, provide loans to small and medium-sized businesses that are not being serviced by their banks. And Block trades for 2 or 3 times sales. You compare that to a Procter & Gamble, right? Which is growing at 2 or 3%. And yeah, and that trades for 5 or 6 or 7 times sales. So in my experience, you know, when markets sit like this, where you can't really see like why there's going to be like a big crisis. In other words, normally when you have this kind of like, I don't know, this mess, this goulash of a mess of what's going on, it's very clear that like all markets are kind of bid up and you tend to have a crash. But it doesn't look like we're going to have a crash, because partly because of what I started with. Why? Well, you know what, the money that the Federal Reserve flooded the economy with, is still there, is still sitting in everything from folks, savings accounts and checking accounts. And then, 15 years of zero interest rate policy means that companies, loaded up on bonds at very low rates that don't come due, for 3, 5, 7 years. So there's enough cash. And generally, crashes are driven by the fact that someone highly levered, representing a large enough part either of the economy or of the markets, can't really, afford to stay in business anymore. And that drives a panic, which kind of like spreads from sort of like, whatever particular asset class, maybe it's real estate, and it spreads into the stock market, and then it spreads all over. But there's plenty of cash around. There's plenty of cash around. Corporations have cash, people have cash, and the government continues to spend like crazy, continuing to flood the economy with cash. So, I mean, it's possible we could have a crash, but however, it's not looking that way, because crashes are driven by the need for liquidity and cash. So it doesn't look like there'll be an immediate crash. Instead, what it looks like, in my opinion, and remember, this live stream, not investment advice, not financial advice, whatever you choose to do with it, completely up to you. It's your money and your responsibility. But it looks like we're going to go through a transition. And we went through something like this in 1993. I was very early in my career, but I can recall where we went through a recession in 1991. I believe the Fed had raised rates. They took rates down a tiny bit. It's not an exact parallel, but then we kind of transitioned to a period where small cap stocks did incredibly well. And there was like a shift from sort of many of the companies that, at the time. Now, I don't remember exactly, what was going up in 1989 or 1990. I'm sure you can look it up on the internet, but there was a shift. And I remember small cap funds just, having performance of 100, 150%. And so they did very well. And in my opinion, something similar is unfolding. Before I came on, I went to check and look at two charts that I look at from time to time to measure what's called the breadth of the market. What's the breadth of the market? It's not that. It is how many stocks are going up. And many people will judge the health of the market. In other words, by how many stocks are going up. So many of you might have seen that there's talk of this Mag 7 stuff. It's not even quite Mag 7, because it's really like Tesla's down 45%. So Tesla is supposedly in that Mag 7, but it's not. Essentially, it's what? Apple, Microsoft, Meta, Amazon, Google, Nvidia, I guess JP Morgan. More or less it's that. So if all of those are the only stocks that are going up, breadth is said to be small. In other words, it's a tiny sliver of the market that is getting money in and where people are buying and selling. When the breadth is wider, it means that a lot of smaller stocks are starting to get money. And this is something that has been sort of like improving slowly, very, very slowly over the last, I'd say, couple of months, even as the talk of Mag 7 has been all over, whatever legacy media website you use to follow, there's been a small but meaningful improvement in money that is slowly coming in to smaller stocks slowly coming in to mid-sized stocks and also starting to push into markets or sectors like biotechnology, for example, where, yeah, you look at the ETFs of biotechnology, they're not up huge, but that's, actually a pretty good sign. In other words, money is just kind of like gently moving in. It's not coming in and, ripping them higher every day by 20 or 30%, like what you're seeing with AI. Instead, they're showing what you normally see at the beginnings of bull markets. And that's what you want to be in my judgment, my opinion, at a period like this when, yeah, all of the things that I mentioned, the big tech stocks, trading for 35 times earnings, 40 times earnings. Yeah, I mean, there's not too many times in history where people have made money by buying stocks at 40 times earnings. So it's just you can go through market history, you can go through any book you go through, and that is not a recipe for making money. Or by buying companies that are trading at 30 times earnings that have growth prospects of 3 or 4%. What you want is to buy companies that are relatively cheap against themselves, in other words, against the business that they represent, against the other companies that they compete with in the market. So it's a relative comparison. And those will start to draw the money of professionals who will start to make valuation judgments, which is that it's unsustainable for these companies to continue to have 30, 40 times earnings. And as people go to sell, the big money is not going to buy. They are sellers. They're going to, sell. So we're seeing the beginnings of this transition. Definitely in biotech, we can start to see it. We're seeing it to a smaller extent in sort of like fintech. Obviously, with crypto, there's been a move in there. Either way, there is the beginnings of like a slightly different market that is not driven by big tech, not driven by safety, stability, or dividend stocks, and not driven by semiconductors and chips, AI or not. And in my opinion, when we look back, let's say 3 years from now, 4 years from now, in my opinion, remember, not financial advice, what will you wish that you sold? Like if I was going to do a swap, will you wish that you bought Nvidia here or Tesla? If I was voting, I'll say this is a no-brainer to me. You would sell Nvidia and you would buy Tesla. If you were choosing between Procter and Gamble and Block with ticker symbol is SQ, well, it's a no-brainer. You'd be selling Procter and Gamble and you'd be buying SQ. I realize these are not like comparable companies, but nonetheless, I'm trying to make a point, which is that there are two markets here. One is incredibly expensive. And yeah, it is going up every day. And I'm sure some people will be like, but I made 100% on Nvidia this year. Hey, I am thrilled for you. I'm, super stoked for you. This is my opinion. This is my viewpoint. And I know many people seek out content that confirms them. I see it as my job really is to come and be like, hey, well, this is my experience. This is my understanding of the world. This is what my reading says. You can agree, disagree, approve, disapprove, follow, not follow, ignore, choose to do whatever you wish. But if I'm right, after 3 years of OGI, opportunity, growth, innovation, which essentially growth stocks, smaller stocks, crypto, getting smashed. I mean, so many of our stocks dropped by 50, 70, 80, 90%, but their businesses often kept growing. Well, 3 years of growth, if you have a company that's going at 20 or 30% while your stock is going this way, the business is going this way, well, they start to look pretty cheap. And professional investors are not dumb. They're not purely price driven, as oftentimes sort of like retail investors, mom and pop investors are driven very much purely by price. And they think if the price is going up, everything is good. But just remember, folks, the market is run by folks who run the market. What does that mean? Well, market makers, are the ones that help set the prices. They can do that by various rules. For example, if they want a stock to rise, they can take in sellers so that it doesn't affect price and keep that price moving up. Why? Because Well, everyone knows that in the markets, we all want rising prices. So we see like, a price that's in decline, then, we'll stop buying. So they want to keep people's confidence high. And they absolutely have ways. It's called market operations to keep prices high and moving higher to continue to get whatever buyers are still there and to lift prices on them and to get them to pay the highest prices. So it's not like the markets are like, some perfect match of buyers and sellers all the time. No, there is a very powerful intermediary in the middle who has a vested interest in whatever it is. If for certain stocks it is to go up, for certain stock it's to go down, and at very high prices. Yeah, you have to be quite wary of what their role is, which is that in general they make money how? Bid and ask spreads, transactions continuing to be high. So you can take, what I'm saying for what it's worth. But for me, if I'm looking forward, I'd want to be in the things that have gotten smashed, that have real businesses. And I've used a three-part sort of like screen and filter to sort of pair through. When we started ATG Digital Media, we took 7, 8 services from Banyan Hill, and then we compressed them really into 3 stock picking tiers and 1 trading tier. So, I mean, I think we had 100 stocks plus in almost every tier. And obviously, with interest rates going up, the basic environment have changed. And then I determined like there were 3 things that I wanted to see to keep a stock in the portfolio. One, they had to show some pathway to profitability. Why? Well, with interest rates at 5%, investors just will not just hand over money to companies that say, well, we're growing at 50%, give us money. They're like, well, why don't you price your product or service to make money? How much growth do you have? Well, once companies start to do that, well, many companies, it turns out, yeah, they didn't have as much growth. So they had to show a path to profitability somewhere in the next 12, 18, 24 months. Second, they had to have above average growth, which 4 to 5% economic growth is high. So I said, 10 to 12%. So it's about double. You got to show that. And the last thing that has become a very big deal is share issuance. Now, most regular investors almost pay no attention to this, but companies are constantly issuing shares, diluting the issuance. And when interest rates were zero, kind of nobody cared. Why? Because interest rates were zero. And a company that could show huge growth, that could go to investors and say, please give me more money. Look, I have 100% growth. I have 95% growth. And investors would give them money because at 0%, it was worthwhile to take that speculation. But no more. No more. Investors are not willing to do that. So you got to keep track of the share count. And companies that, continue to issue shares, yeah, I mean, their stocks are not being supported, not being bid up. And so using all of those cuts, if you go and look through that and you focus on, again, they show a clear path to profitability. And generally, companies that are doing that have done, well, a few things, which is one, they have sort of like pared back the number of projects that they work on, focused on the thing that makes them money. They've cut costs and just generally become much more financially disciplined. And then you'll know that, they have a real product or service if their growth has continued to be, whatever, 10, 12, or at least 15 or 20%. In other words, after doing all that, they still have a fast growing business. And then the path to profitability is proven by the fact that, hey, the cash balance goes up and they're not issuing more shares. You focus on that. And in my opinion, this transition moment, which is what I believe is unfolding, not going to unfold, unfolding because of very high prices in, all of the things that I mentioned and very low prices here. Well, the money is going to start to first trickle, 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 trickle. And then you'll start to see this move up and that'll start to draw more money in because what are people attracted to in financial markets? We want our prices to go up, right? That's what we want, right? Market makers know that. The folks who run the markets, they know that. And if I were to guess, well, who's been buying all the smash stuff that has good properties, right? I mean, it's not like, the investment banks are dumb, right? They run the market. It's not like they don't have access to analysts. It's not like they don't understand the history that's in all these books about valuations. They got all that. Who's been buying all this stuff for the last 3 years? Yeah, I will tell you, well, somewhere near the bottom where you can accumulate a lot of inventory, because that's the way these investment banks think of it, inventory. Yeah, they were buying. In other words, they're long. If I'm right, they're long. They own this because somebody has to buy it. If everybody's selling, somebody has to take it onto the other side. And you know that, investors, both professionals and retail investors, were selling. Why? Because that's the reason the price is pushing down. Prices don't get pushed down if people are buying. Prices get pushed down when people are selling and there's nobody to buy, and then the price keeps, being shifted down. So if I'm right, well, Wall Street, they own, cheap inventory, merchandise from their perspective. That's the way they look at it. They see stocks as a piece of merchandise to be marked up. And they own growth for sure. They own small cap because this stuff has been essentially in kind of like a bear market for a minimum of like 3, in some cases 5, 7 years, and they will mark it up. And as they mark it up, people will get more optimistic, start to focus on the more optimistic, positive starts of whatever it is that they do, and will get marked up, and the money will start to flow from where it is to where it's there. And that's where I believe 2024 is leading us. So growth, smaller companies, OGI companies, crypto, this is where you increasingly want to move your money into. Remember, not financial advice, investment or investment advice, just my opinion and point of view. All right, I'm going to end it there. I have a question here from Rose. You can put up any questions if you have. Says, hi, Paul. Can you speak today on Palantir surge? Palantir is, in our opinion, the leading sort of like enterprise artificial intelligence data and information based company. Remember, NVIDIA and others are chip makers. Palantir sells its services, for example, to the US government, to the UK government, to various businesses. And they seem to be the only company that has scale in that business. They started, I think, about 12 years ago. And if I am right about this business, which is that artificial intelligence of the kind services that they offer, it's not like, let's say you're helping the CIA or the FBI. They're not going to contract with like 6 companies, right? Because they have to give very sensitive information for this kind of artificial intelligence analysis to be done. So in the way that I view it, it's a kind of monopoly, but it is not a stock that's going to see growth of 150% because it's not a cyclical company. This is a sort of like a steady growth company that will put out above average growth many years. Some years will be less. But if I'm right, as the dominant enterprise AI company, they will get contracts with the vast majority of governments around the world, with the vast majority of big companies around the world. And, this, in my opinion, is one of the premier AI plays for the long term. Today, I think like last quarter, there was a disappointment. This year, this quarter, it's a surprise. The quarter to quarter game is unpredictable. So today's a spike. I would not be buying things ever on a spike. I'll tell you that much. Wait till things subside down. Still, longer term, Palantir, AI, in my opinion, kind of synonymous. Pulverizer says, any thoughts on China markets? I saw that you said my Baba is doing well. I am not particularly enamored of China because from everything that I read, their big 3 sort of bets from the last 2 or 3 decades, which is their infrastructure, housing, and exports are all in very serious decline. We do have one Chinese stock in the silver tier at ATG Digital. It's Xpeng. I'm very positive on their EV export sector. I believe that in 5, 7, 10 years, we're going to see that the Chinese EV makers were like the equivalent of the Japanese car makers from the 1970s and 1980s. And so that is one sector where I am positive, and we may add more Chinese EV stocks to various portfolios as we see their deliveries and their growth starting to rise. Doug wants to know, Paul, word on the street is the rug pull is coming this month. What do you think? A rug pull on what? I mean, if you're talking about a rug pull in S&P 500, I doubt it. There's just too much money in the system. And we have now a philosophy of making sure that everything operates. So, I mean, was 2022 a rug pull of 25%? I mean, 25% for somebody who went through 2008 was, relatively easy going compared to 2008 when, that was brutal. I don't expect the S&P 500 to crash. I expect it to kind of like, drift down lower, go back higher as expectations around interest rates go up and forth. And then, and then money peels out from these very highly valued stocks into things that are much cheaper. That is my personal expectation. Peter asks, what do you think the high will be for DRV? DRV is a 3x leveraged ETF that bets on commercial real estate prices going lower. It's filled with sort of like REITs and all of these things. Well, we're going to go in and out of this because I doubt that the commercial real estate problem is going to be solved in 1 month or 2 months. It is, a multi-trillion-dollar asset class where the prices are set only when a building sells. The regulators and government are not requiring banks that hold a vast majority of this real estate to mark them down. The rest is owned in commercial mortgage-backed securities. And so the prices are going to sometimes just drop suddenly. And so into that we'll sell we've done this is, by the way, in our platinum trading tier where we bought call options on DRV, and we'll look to go in and out a few times over the next, I think, 12, 18 months until we see that, the call premiums start to reflect the fact that other people understand this trade is on. The real estate prices have dropped, and then, we'll start to move on to something else. Steve wants to know, Jerome Powell spoke on 60 Minutes on Sunday night. It was interesting that Scott Pelley asked him a couple of questions about when the Fed will start cutting interest rates. Yeah, I mean, I have made a couple of Ballman speculating podcasts and told people my view, which is that, in my opinion, we are in a rising interest rate cycle, which is that we will, if I'm right, over the next 40, 50 years, generally speaking, we'll just continue to see higher rates. Having said that, we have gone from 0 to 5% in record time. Comparing it to the last rising interest rate cycle, which is between 1940 and 1981, it took from 1940 to 1968 to get to 0 to 5%. So I have theorized that we are going to sit somewhere in and around here, let's say plus or minus 1% for the next 5, 10, maybe 15 years. And every time inflation goes high and is hot, people will panic about higher rates, but the Fed will mostly sit still. Every time it's too low, people will think the Fed is going to cut rates, and they might by some small amount. But I believe that generally speaking, we're going to have a period where, generally speaking, the economy is too hot for them to cut and is too cold. Too hot for them to. No, I'm getting my references wrong. Yeah, it's too cold for them to raise and too hot for them to cut. And I think we're just going to bounce around that. And things like the S&P 500 and others will sort of like ride this expectation curve, which is why you want to own something that is not really kind of related to all of that, in my opinion. Um, yeah, I don't think that, the game is different today. Steve wants to know, do you think as the Fed cuts rates, money comes out? I don't think that that's what the game is anymore. It's now genuinely about sales growth and about earnings growth, and having some sort of differentiated business profile that draws investors to come and want to buy your stock. I don't think expecting interest rates to come and that to cause pumps higher. I don't think that's a realistic bet in a rising interest rate cycle. I just don't think that that's going to happen. And if you listen to Fed Chairman Powell, he said, well, yeah, inflation is trickling down, but we want to see it continue for, he said maybe 6 months. And we're thinking about maybe cutting, 2 or 3 times this year, but we will have to see. It was very wishy-washy. And I think if you're going to make bets on that, my best guess that you're going to be whiplashed. Every time the expectation runs higher, prices will spike. When then the expectations will get dashed, and then they'll sink. Instead, having gone back and studied the period between 1940 and 1968, 1970. Yeah, I mean, there were a lot of stocks that were in enormous growth periods, and those are the things that boomed during that period of time, and that's what I believe that we own. All right, no more questions, and I have run now a record 41 minutes. Thanks everyone for showing up. I keep saying that I'll do another podcast, but another live stream, but I try to keep the content to be relevant to our time. If you're interested in paid subscriptions, atgdigital.media, we just have a new website, which the portfolios are better and everything else. So please check us out. And I'll be back at the very least next Tuesday. Check out Ballman Podcasts, Ballman Speculating Podcast. I just released a new podcast recently. I'm on X and, of course, ATG Digital Media. Thanks, everyone. See you soon. Bye-bye.